computation of return for investment stocks. Whenever I am thinking to invest my precious money, then always I will think for return. How much return I will get from my investment, that is earnings. If I am interested to invest in stocks, that is shares, then how will compute the return? Today I am going to discuss that things. That is how we will compute the return for any investment in shares. First of all, I want to discuss the formula for finding out or computation of return. In the case of share, there are two types of returns. One is due to appreciation of the share price, that is due to increase in the value or price of the share, and second is dividend received during the period. That's why the formula for computation of return for share is appreciation of share price plus dividend received during the period, and this is the investment, and it is multiplied by 100 to get the return in percentage. This is the formula. Now, for better understanding, I have shown one example. Suppose I have invested in shares of the company ABC Limited. I have purchased 100 number of shares. At the time of purchasing, the market price of the share is 225 per share. After 1 year, that means at the end of the year, I have sold my shares. The price of sale value, share price per share is 267.50. This is the sale price per unit of share. The par value of the share is ₹10. Dividend I have received during the period is 25%. The company declared 25% dividend. Then how will compute the return? This is the end period price, PT plus 1, which I have already mentioned, and this is the purchase price per unit of the share. Dividend received per share is 25% of the face value, that is 10 into 25%. This is per share. Now, if I put all these values in the formula which I have already shown, this is, then you will see the return value is 20%. In this way, you can calculate the return percentage from your investment in shares or earning from the investment. This percentage of return not always positive, it may be negative also. Negative means you are in loss. Profit means you are in profit. The return when you are in profit. Another example is also shown for negative return. Suppose the end price of the share is 200 rupees per share end of the period, not this. That means the share price has been decreased. Whatever the price you have purchased, that is 225, it has been decreased to rupees 200 per share. Then how will compute the return? The formula is same. This is the final price of the share, this is the initial price, and you have purchased 100 shares, that's why you multiply by 100, and this is the dividend per share and multiplied by 100, and this is your investment money. In this case the return is negative, that is you are in loss. Now the case I have discussed, this is for a single year. You may be interested to know the return over a long span of time. It may be 5 years, 10 years, 15 years, 20 years. Then I will compute it. From the past data, same way which I have already discussed, you can calculate the year-wise return. Here I have taken the example 2 to show what this company over 10 years span of time. Individually I have calculated the returns year-wise with the same formula which has been recorded here. That is, first year return is this 21.84%, second year return is this in this way, third year it was in loss, the return was negative, seventh year also the return is negative in this way, 10th year the return is this. How will you compute? This is the formula. Simply by averaging you will get the return. I have added all the returns of 10 years and divided by 10, that is 9.14%. That is, over the span of 10 years, on an average, the return from the share of that company is 9.14%. Now, till now I have discussed the return on the basis of past records, past data. That means deterministic data. But if I want to forecast or estimate the future return of the share, then how will do it? This is the formula. This is expected return. That means in this case, along with the return percentage, the probability will be given, or you have to know the probability. That means P1 is the probability for occurrence of R1 percentage of return in this way. P2 is the probability to happen R2 percentage of return, and the expected return will be this. This is the formula. In this case we will not tell as average, as it is not deterministic, it is probabilistic. That's why it is called expected return. Again we are discussing through an example how you will forecast the future return or expected return. Here is a problem. Suppose you are investing your money to any business or any project whose return depends on different economic conditions. If the economy is in the growth phase, you have estimated, you have calculated that the return will be this 18.5%. If the economic condition is in expansion phase, the return will be 10.5%. If it is in stagnation phase, then the return will be only 1%. If the economy is in decline phase, then the return will be negative, loss, which is negative 6%. The occurrence probability of the economic conditions are equal in this case. Forced situations, that's why the probability is same, 0.25, 0.25, like that. And the sum total is 1. We know the sum total of probability is 1. It is not necessary that always it will be equal, but in this case it is a coincidence that we have taken equal probability for happening of the economic conditions. But sum total must be 1. For easy understanding, here we have written the final column, just multiplying this with this, the value is this, that is the expected rate of return, and if you add it, the total value will be 6.00. That is 6%. This is the expected return. If you put in the formula, this is same. Individually we have taken the value and the final is 6.00. That is the expected return from the investment is 6%. In this way you can also forecast the return. Now why we are doing this? Again I am repeating, actually to invest my precious money, it is very important to know how much return I will get. What is the expectation of my return? Accordingly I will invest my money. But here is an important note, please follow it. Return is not only the criteria for investment. With return you must have to consider the risk also. How much risk is involved to get that return? Only return is not sufficient. How risk will be calculated and how we take decision for investment by applying risk and return, that I will discuss in my next video. That's why please look that video to get the complete idea how and when you will invest your precious money by applying risk and return. That means I will discuss detailed risks in my next video with application of risk return for investment decision. Thank you.